Good morning, everyone, and thank you for joining us for the PMA-CIBC Summit Series. Thank you to everyone in the audience today and across the industry for such strong support to keep our program fresh with new topics and discussions each month. If you're joining us from outside of the Toronto area and you are watching this on YouTube, please like our channel so that we can get more content out to you. Before we get started with our program, we acknowledge the land that we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people, and is now home to many diverse First Nations, Inuit and Métis. We acknowledge Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We're grateful to have this opportunity to work on this land, and by doing so, we give our respect to its first inhabitants. Again, my name is Markovic, and on behalf of PMA-Brethour Realty Group, CIBC, our title sponsor and our media partner, we are thrilled to have you all join us. Today, we have a very exciting and well-recognized gentleman on our program today, Ben Tal from CIBC. And as many of you know, Ben has been with us on our program for many times over the last few years. Before I introduce Ben, I wanted to also let you know that in January, we will be launching season 5 of this program. So please stay tuned for more updates about that. Please reach out to us if you would like information about sponsorship of this program. Please also reach out to us if you'd like to participate on a panel in the future. I'm going to turn it over to Ben and to Andy now, and then I'll come back at the end to wrap up, and I'll also be looking after the Q&A. So please, if you have questions, please be sure to post them in the Q&A section on your screen. Welcome, Ben. Andy.
Good afternoon, or almost afternoon, to everyone. It's great to be here with you all. And hi, Ben. How are you doing? You're looking younger. Must be all that interest rate movement, I think, that causes such a thing. Let me begin with kind of a premise that says, are we at the precipice, or are we in fact in a perpetuation, more of the same? The premise really is based on what I'm looking at now, the impact of the most recent rate increase in June, July, and a couple things occurred as a result of that. And it'll be interesting to hear Ben's comments on this, but from the guys on the ground like me in the dirt, we saw continued downward pressure on prices, particularly from that period after the June, July rate increase. You saw it, of course, in the resale market with a surge in listing supply in September to over 19,000 units. That's the highest level that we've reached since the early 2000s. And you saw a movement in price just in that period from May through September in the resale market of about 6% downward pressure. Now, this varies by region and varies by product type, so please don't take me so literally on some of the numbers I'll throw at you. You know, the price adjustment since the peak of March of 22, when we started this 10-time rate movement, is about 14-15% adjustment. And we're probably in for a period now in September through the balance of this year for kind of a bumpy ride. Stability is very important to the consumer and to our investor and consumer in this market, whether it's condo high-rise or low-rise product. And that sense of uncertainty in the market got thrown for a loop with what's occurring in the Middle East. Now, the uncertainty leads to confusion, and confusion leads to deferral. We just don't make a major decision at this point. And you saw sales volume on the resale scene in September, drop now effectively 15% from where we had been in. And the actual year over year, we think for resales going to come in at probably about a 50% level. This will be the lowest level of resale volume. It'll probably hit around 65,000 units, and the 10-year average is 95. So you're feeling this reduction in volume of demand, volume of absorption of sales, together with a surge in supply. So if I have large supply and softening of demand, that generally leads to continuing downward pressure on prices. And how much, we don't know. It really will depend on the incremental increase in supply. Now, I had always used a number of around 24 to 25,000 units of supply as a market in complete balance, shifting over to a buyer's market. We're now at 19,000. It'll go to 22, maybe even 23,000 by the end of November, as uncertainty continues to filter through this marketplace. And so you're going to have a buyer's market environment in the next several months. And combine that with world events, it's a picture of a market in quite a bit of change or uncertainty. I call it just bumpy. It's not, I don't think it's a precipice. I do think it's more of a condition balanced from stability, but that's yet to be told. We'll see where it happens. On the new home side, boy, the numbers are not pretty. We're down nearly 80% on the 10-year average. Sales activity in low rise has been very tough. The overall year to date is around 13,000 units, and we may end up at around 15,000. That's the lowest level since 1989, just before we entered into what was probably our toughest recessionary period in the last several decades. Whether we're technically in a recession would be a great question to answer for Ben, and it feels like it a bit right at this moment. So the key going forward is both stability of rate, but that's been being pushed up. Mortgage rates are being pushed up by a surging bond yield. So we're kind of in a that's adding to the uncertainty of a market. The consumer's waiting on the sidelines for a best deal. That best deal doesn't have to be priced necessarily, but it's price and terms and conditions. It's all the combination of those things. You're seeing a few really interesting success stories. Cachet in Binsbrook, the other side of Hamilton, selling very strong price leads on towns through small lot singles. Towns at 700,000. That's a new price level. Tribute opening in a place like Lindsay with a big community, but a price point on a townhouse in the 650 range. And it'll be interesting to see what the take up of that is. It might take a while to get started, but strong. And then at the other end of the spectrum, look at Geranium up in Claremont this past week with $2.5 million singles on almost 1 acre lots, and moves out 30 of them. It's such an unusual product opportunity in this market. I think just captured the attention of those who are sitting there waiting. So we've got pent-up demand. We've got continuing immigration. We've got innovation in product development. Smaller is better, and basement apartments everywhere. I don't think I'm seeing a house come across our desk without one. It's the long-term investment opportunity for real estate in the GTA that's important to remember. This will pass. This challenge of our marketplace will pass, and it's driven, if you like, in two parts, where if it's almost self-imposed by government regulatory authority. At this moment in time, we held yesterday on the rate movement, hurrah, but it's time for a cut. It's time for the feds the Bank of Canada to show that there's hope in this marketplace. I know it's been projected well into 24, but the time is now. The housing market needs it. We're underperforming when the world, for the first time in decades, is talking about supply and improving supply to target affordability. We're falling further and further and further behind. The good news of that is it's a perfect time to increase supply. So provincial and municipal levels of government can work to actually move on the supply side. And the federal government's influence can come with, 1, a rate cut, and 2, in December the 6th, I think is their date. Even 25 basis points will be an important signal to the market that it's okay, things are going to be fine. Longer term is good. And then the MQR, I know harp on this endlessly, but the mortgage qualifying rate adding 2 percentage points is redundant. It's piling on. It's an economic gatekeeper, and it's slowing and pushing downward the demand side. If the feds want to play on the GDS and TDS ratio side to be more assured of people's ability to qualify, that's one thing, and probably we can manage. but the actual 2 points extra on MQR is really hurting at the moment against the other factors. So the good news is longer term. The short term's pretty bumpy. I'm going to stop there and introduce to you Benjamin Tall. Now, Ben needs no introduction. I don't necessarily need to emphasize how smart he is, but he is. His intuitiveness and understanding of the economics and the simplicity that he puts it in forward for lay persons like you and I to understand is marvelous. And deputy economic chairman of CIBC, and he's well known within the industry now. And I'm going to turn it over to you, Ben, to give us the real goods and your own sense of where we're going forward in these next months ahead and into 24.
Yes,
staying alive till 25. Thanks, Ben.
Absolutely. But let me ask you one question before. The increase in supply, resale, what's behind that in your opinion?
Well, I think it's market uncertainty. It's affordability renewal. It's those that may have bought at a specific period of time. Let's call it the pandemic chaos, and where we were quite irrational during that period. And now people finding themselves being stretched to make that payment. Let's put the house on the market and see if we can adjust in that way. So I think it's reflective of both high rates and market conditions, and that period of pandemic chaos that put us all a little out of whack. And as we know, consumer debt is very high, and this is part of the adjustment. So I think that's part of, and by the way, the growth in that 19,000 units is very heavily weighted to condo. So the condo market in particular, which was almost 80% investment driven, is where you're seeing a significant upside in that supply listing. So that's an area to watch very carefully. And we have somewhere in the neighborhood of 30,000 plus units to close and deliver now through spring of next year. And that'll just add to an investor's concern about both, can I close? Will I have challenging closing? Can I finance this? I'm underwater anyway. I think I'll put it on the market. So you're seeing that part of the trend line, and that's going to continue. That's where I see it. I think we'll see even higher levels of supply in the next couple of months. By the 1st of December, well over 20,000.
Yeah, I agree. I totally agree. And I think that we have to realize that until now, the lack of supply was protecting prices, and now you don't have this buffer anymore. And that's something that will put downward pressure on prices, unfortunately. Listen, I do believe that the housing market is in a recession. If you look at sales, if you look at the activity, it's basically consistent with recessionary period. This is the most difficult adjustment that we have seen. We have to remember that this adjustment came after a crazy COVID period. So it's not really a net adjustment, it's just undoing craziness of COVID. The question, of course, is all about interest rates. The Bank of Canada is a biased bank. They will prefer to overshoot as opposed to undershoot. If you give them two options, inflation versus a recession, they will take a recession any day. So that's basically more or less where we are. I think that the Bank of Canada decided not to move. I think they are done. But I think that the next cut, unfortunately, Andrew, is not December. It's not January, it's not February. It's mid-2024.
I guess I was thinking with my heart, not my head.
Yeah, we have to live with this because there are two ways of overshooting. One is you raise interest rates way too high. The other is you keep them high for too long, and they will do both. We have to realize that, if the Bank of Canada was an AI machine, they would have stopped 50 basis points ago. They are overshooting, but they are overshooting by design because they know how to fight a recession. They don't know how to fight inflation. So for them, inflation is the issue. So there is a tug of war now between a slowing economy, and the economy is slowing big time, big time. We are basically on the verge of a recession. We are already in a per capita recession. Per capita GDP is down by 2%, per capita consumption is down by 3%. The only reason why we are not in total recession is because of the 1.2 million people that we got into this country. But that's not a way to elevate the GDP growth to above zero. So per capita, we are in a recession. The economy is slowing down. There is no question about it. So there is a tug of war between that and inflation that is still accelerating. And nobody will be able to convince me that with the economy slowing so rapidly and basically approaching recession, inflation will remain elevated. Inflation is a lagging indicator. Inflation will follow GDP. And that's exactly where we are going. So,
If I don't mean to interrupt, but if I took out the, if inflation's at 3.8% and I take out the impact of mortgage rates and rental, where does that leave me on the inflation?
Absolutely, you're absolutely right. It's 2%. So
there you go.
You're 2%. So that's why I believe that they're overshooting, because interest payments on mortgages is rising by 30% a year. It's the biggest part of shelter inflation. So on the one hand, the Bank of Canada is raising interest rates to fight inflation. On the other end, by raising interest rates, they are adding to inflation vis-a-vis mortgage interest payments. And of course, with higher interest rates, people are not buying, they are renting, so rent is rising by 6-7%. So by their action, the Bank of Canada is actually adding to inflation. So when you remove those two forces, inflation is basically at 2%. Another thing that is happening here is supply chain that is improving dramatically. This is very significant, major negative inflationary force. So the price mechanism, so the effectiveness of monetary policy, because if all the inflation is coming from supply, the Bank of Canada is impotent in its ability to deal with the situation. But if it's coming from demand, and it's coming from demand now, the ability to deal with the situation is better. So the effectiveness of monetary policy is rising. And another factor is profit margins. We have a situation in which many retailers were hiding behind the fog of supply chain and raising prices and profit margins. Now you have nowhere to basically hide anymore. Profit margins are down. That's a major underrated disinflationary force. But the most significant issue is the labor market. We need to see the labor market slowing down. And I suggest the following. I suggest that the labor market is normalizing. We have all kinds of measures of labor market activity, and it's normalizing big time. We have a situation in which the quits rate, the rate at which people are quitting, is now back to normal. Before, the wage for quitters was notably higher than the wage of stayers. Now it's back to normal. So this means that if you have people not quitting, the labor market, the bargaining power is not as strong. You look at the relationship between the unemployment rate and the vacancy rate is basically almost back to normal. You look at the vacancy rate itself. Remember when we had this 1 million people missing, shortage of people, it's back to normal. It's back to 2019. So all those vacancies were one big mirage. This will be translated into a weaker wage growth and higher unemployment rate. That's exactly what the Bank of Canada would like to see. So overall, I think that the labor market is normalizing big time. I think that it's just a question of time. The Bank of Canada is overshooting, will remain overshooting, and will continue with the interest rates until, let's say, June, July of next year before cutting. The question is when they cut, by how much they cut. And we started this saga at 175, we're at 5 now. Let's hope that they are finishing here, they are ending here. Listen, the Bank of Canada will have to remain hawkish in its language because they are biased and they don't want you to relax. They don't want the long end of the curve to go down dramatically. So they will continue to tell you if inflation is sticky, we'll raise again. But I think they are done. So we are at 5 now. We'll be at 5 by second, third quarter of 2024, and we cut slowly to what? I say 3. So notably higher than before the 175, reflecting the fact that there are a lot of inflationary forces like deglobalization, just in time, just in case inventories. All those forces to me suggest that there is more inflation coming in the background from a long-term perspective. But the target is 2%, same target. So when you have the same target, more inflation, by definition, interest rates have to be higher. And let me remind you that this industry, the real estate industry, can do extremely well at a 3% overnight rate. But the only thing you need is stability. You don't need 2%, you don't need 1%, you don't need 0. You need a reasonable price for money, which is about 3%. And if you go in the past, this industry can do extremely well. So I'm not too worried about it. Totally agree that the next few quarters will be bumpy. Totally agree that we are basically in a recessionary condition. I see prices continuing to go down because I don't see the buffer that protected. And this consumer, remember, in previous conversations, we were discussing the excess savings that consumers were sitting on, $165 billion. This excess savings is now zero. That was protecting the consumer from the Bank of Canada. Now the Bank of Canada is more powerful because you don't have this protection. The buffer is no longer there. Another source of vulnerability to the economy. And that's why this economy will operate very close to 0% GDP growth, with the housing market basically in recessionary territory. So expect prices to go down. I totally agree with you that the condo space is a bit concerning. There's no question about it. Supply will be rising, and we simply don't have demand. About 54% of investors are in negative cash flow. And at the minimum, they are not buying more. But more than that, they are starting to sell. We see a lot of stress sales happening. And that's something that the stress sales happening, and that's an issue. So that will be the next 6 months.
And if they won't, if the Bank of Canada won't respond to my heartfelt plea to give us a signal and come off 25 basis points sooner than next June, let's say, is there any hope that there might be some rational thinking on the MQR and knock that very draconian piece of restriction on affordability down, eliminate, or modify? Is there? I mean, I know they'll meet in December to with OSFI Finance and the Bank of Canada to review it. Is there any possibility that we might see that change?
At the moment, from OSFI, I know that the answer is no. They have no motivation whatsoever to do so. They have no appetite to do so. Maybe you're right. If they don't cut interest rates, they will reconsider it. But quite frankly, I doubt it very much. I doubt it. So I think that we have a situation in which we need the Bank of Canada to cut. Remember, in 2020, today, if you renew your mortgages on average, if you renew your mortgage today, the average increase in spending on your mortgage is 20%. Now, if you took the mortgage in 2020 and you renew today, the average increase is 30%. So, but that's not my concern. My concern is the 25, 26 cohort.
Right.
The people who took mortgages in 2020, 2021 for 5 years. 57% of all mortgages will be reset. That's something that we have to recognize. So I think that we have a major issue, and the Bank of Canada has to cut interest rates. Has to cut interest rates in order to limit the pain. There will be pain, there will be foreclosures. Banks are all ready for that. But if you don't cut interest rates and you basically adjust from 2020's rate to today's rate, we are talking about a significant increase in delinquencies. If you cut interest rates by, let's say, 150, 200 basis points, which is a very reasonable scenario by the end of 2025, I think the pain will be reasonable. Still a pain, but reasonable. And I think that's the more or less the scenario. Now, to go back to your point, everything what we are talking now will not bring affordability back to the housing market. Prices will fall, activity will slow down, but this is an adjustment. This is a cyclical story following COVID. This is not a fundamental weakness in the market. The opposite is the case. Whatever we are not building now and we are not building enough will come to visit us later in 2 years from now. The demand continues. And in fact, we underestimate the number of people in Canada. We underestimate the number of non-permanent residents. Immigration continues to be very strong. So the fundamentals of this market are extremely, extremely strong. We just have to go through this period.
Is there an impact of world events around us that are also adding to the uncertainty, particularly spiking oil prices, which will be underlying inflation, and that these kind of world events have been added to the uncertainty in the consumer's mind? Does that also influence what happens within the next, obviously short term, but even the next 6 months to a year?
I think that the number one issue is oil prices. The Middle East conflict, the Hamas-Israel conflict can be minor in terms of the impact on the market in Canada, as long as Iran does not participate in a very significant way and oil prices don't go dramatically. But that's the risk that we are facing. If oil prices go up dramatically, that's a major inflationary shock that the Bank of Canada is not expecting now and might delay the rate cuts. That's something that we have to monitor. There's no question about it. Nobody knows. It's one of those known unknown, but we have to monitor it. Absolutely, this is a risk.
If immigration levels continue at this million a year level, is that appropriate, or should we be readjusting our ability to handle new immigrants?
Yeah.
I'm totally supportive of we must have it here in Canada, given our birth rate, but we need it for economic growth and stimulus. But the levels that we're at the moment appear to be putting such undue strain both on our ability to provide housing, healthcare, fundamental services. Is it time to revisit that at the moment? Even a suspension in the short term might help if it's. What's your thinking on that?
Yeah, we have to distinguish between new immigrants and non-permanent residents. My understanding is the government is not going to touch new immigrants. It's about 500,000. That target will remain. They might be playing with the point system to bring, for example, more construction workers, but overall, it's the same. At the same time, when it comes to foreign students, which is part of non-permanent residents, I think that we have to make sure that the number that is coming is consistent with our ability to house them. If you are a university and you bring people, you have to be able to house them. And I think that the government will go after some of those, what we call Mickey Mouse colleges that are not really colleges, that attract foreign students, collect the money, offer nothing. And for many of those foreign students, that's simply a way to enter Canada. They pay $30,000 a year and they're in Canada. And then they apply for within Canada. We underestimate their numbers in a very significant way. So I have a feeling that from talking to the government about it and had the opportunity to do so, that they will go after those.
What portion would that be of the 750,000 foreign students at our university?
Very difficult to say, but I have a feeling that the number of foreign students next year will fall notably.
Okay. Interesting. The foreign buyers limitations had a very modest level of influence on our real estate market traditionally, yet that remains, of course, prohibited for foreign buyers into our market. That remains until January 2025. It sends a message beyond the actual hard numbers, which were a very small portion of our market, but it sends a message that we don't want foreign investment here in this country. It's the wrong kind of approach. Do you see that changing at all from the feds, or are we in for this program to remain clearly through till 25?
I don't think they're going to change it, quite frankly. I think that their focus is on affordability, and they believe that foreign investors inflate the market. It's all about affordability now, and it's all about supply. Their focus is the purpose-built rental market now. That was the GST change came through. That's something that we recommended, by the way. And I'm glad that they did it. It was the right move. But I doubt they will make any change to the foreign investor thing. It might actually extend it after it expires.
Interesting. Chris, I'm going to pass it back to you, to our general audience for questions. Thank you, Ben. That was a terrific discussion and presentation.
Thank you.
Thanks, Ben. And I don't want to start the questioning too soon, just to give you a chance to finish off what you wanted to speak to us today about. But a couple of them have come in. A really good one to start us off, and it might continue the conversation a bit, is if the US is forced to raise rates next week, and then again in December, let's say, due to this jump in inflation in the report today, will Canada be forced to at least raise one more time?
No, actually,
in some way?
The answer is no, because it's either the Bank of Canada is overshooting or the Fed is undershooting. The Fed has no business being only 25 basis points higher than Canada. Usually the rate should be 75 to 100 basis points higher because the effectiveness of monetary policy in Canada is higher than in the US. So the fact that the spread between US and Canada is only 25 basis points is mispricing somewhere. So that's why I believe that it doesn't make any difference if the Fed moves, the Bank of Canada should not follow.
Okay, you know, and Daryl, there's your answer. Thank you, Daryl, for the question. A good one connected to it is from Stephen. Are you concerned that an interest rate cut before the US might tank or impact our dollar?
Yes, I think that the Bank of Canada will cut before the US. The US economy is much stronger. Monetary policy is less effective, and that's why it takes them longer to slow down the economy. So we believe that the Fed will cut about a quarter after the Bank of Canada. This means that actually the Canadian dollar will go up a little bit, which is exactly what they would like to see.
I've got a question. I'm going to pose it to both of you. It's again from the audience. Marcel, thank you for this one. And I love to see the viewpoint if it's opposing or similar. Will this amortization rate be increased to make more things affordable?
So the question is to what extent they will.
Yeah, to what extent exactly? Who wants to take it first?
Andrew, go ahead.
Well, it's already happening. The 25 to 30 to 35, and I can't recall the actual hard stats, but on renewal that banks are doing with their customers, where there's stress from a renewal, the lengthening of the amortization is has been a welcome adjustment. Yes, I think it'll continue, and we will see more of that in a ability to qualify someone for a mortgage. That really comes back to MQR, my 2 points plus, and amortization may balance out a little bit. But the most of us, I don't know what the stat is. I was looking at it in the U.S. that the U.S. buyer, and I think he moves more frequently than we do in Canada, but their average movement is like 3.5 years from the time they buy to the time they move their next house. So a 30-year fixed term in the U.S. is meaningless to that. Although it's causing people to remain in place right now, really, in that the movement in rate or change in rate, and but the amortization will help in that decision to both qualify and over the long term. This real estate's a long-term investment. I really like Ben's comment about this being a cyclical period. This isn't the precipice. This is, a predilection of what we're about to experience, of a bumpy period. It's cyclical, and amortization is a very small way, but it is a real way that says, I'm not going to stay in my house for 35 or 40 years. I'm going to be turning this over at some point in time, maybe on a 5 to 10 year horizon, and as my life world changes, and that's very typical. So I think you'll see more of it. Ben?
Yeah, absolutely. I totally agree that that's the case. We have to remember that this is just a cyclical story. In fact, if you told me that interest rates will go from 0 to 7% over such a short period of time, I will tell you the housing market will be much worse. The fact that it's not tells you how strong the fundamentals are.
Yeah, I mean, it's not like we're not selling houses. We're still selling houses. Just our rate of absorption is half of where we were, and we'll continue on that level until we can see some adjustment in interest rate and that carrying cost. And for the consumer, it's so much psychological. It's so much a sense of stability, certainty, employment, my life world around me, world factors. These all around the kitchen table cause a decision to say, I think we'll just lie low and stay where we are, or yes, I want to move up to something better, move down, move over, move out, whatever the case might be. And at the moment, we're in a kind of stay put function. I'm just all of these factors we've talked about that Ben has outlaid so brilliantly is really causing people to kind of stay right where they are at the moment and weigh these factors. Change will come with signals. Consumer reacts to things very interesting. It was probably in the spring, as we'd had stability for nearly 6-7 months of no rate movement, and then suddenly we saw a return to a much more buoyant market in this past spring. And in fact, we recovered back almost 8 or 9% of price that we'd given back in the fall of 22. So that rate movement in June, July, which we didn't think was necessary, but at the same time, it was a response to what was happening back in the spring. I think that right now once we see a signal within this market that the demand curve is being pent up like nobody's business, and the fear would be, I guess, from Bank of Canada that they don't want to move rates down too quickly and cause that spark that we saw in the spring. That's the kind of balancing act they've got to go through. We're in the mood now for a signal. We need something now because this is feeling very challenging. So we'll wait that. But coming all the way back to the question, amortization is one little wee small piece that allows us to perhaps reduce the carrying cost for somebody.
Gentlemen, we have a few more minutes here, so I'm going to keep going with some great questions from the audience today. So thank you very much, ladies and gentlemen in the audience, for your questions. Eddie White, I'm going to pose this one to you, Ben. What do you believe the neutral rate to be today? And what do you think it could be in a year from now?
Yes, I think that a reasonable rate, remember, we started at 175, we are at 5. I think something at around 275, 3% neutral rate for the Bank of Canada is very reasonable. And again, we are in an environment in which you can operate and function beautifully in this kind of environment. So about 2.5 to 3 is a reasonable guess.
I'm going to stay on rates, and then we might wrap up our questions to talk a little bit about some regional differences in our activity that we're seeing across the country. But staying on rates, Norman Godfrey, thank you. What effect will a decline in low-rise starts have on our workforce? Andy, I'm going to put that one on you.
Well, this will be interesting to see on as the banks have moved now quickly on reducing their labor force. The telecoms have moved dramatically. Lower volume in sales activity means that the order books are not full going forward, and that should create a diminishing demand from the labor side on the wage world, and also have some influence on material cost. Although most of our material, drywall and lumber, is driven by American market influences, but they too are also slowing down, where their 30-year rate has moved to 7%. That has caused a similar kind of slowdown in general new housing construction. So the picture going forward is the order book's not full, and that's going to be a benefit to the hard cost side. But in the end, so much of the sale price of a new home today is caught up in indirect taxes, from HST to development charge to even the Law Society of Upper Canada's minimalist little fee. Today, we're exceeding $200,000 a unit, regardless of the unit type, form, or location, in indirect taxes. And that is an enormous burden on the affordability side, and something that needs to be addressed. It doesn't take a rocket science to look at HST and GST in the various provinces on rental to be taken out by the feds, which is a great move. Let's do the same for first-time buyers. Let's do the same for some form of affordable housing at various tiers to reduce the tax burden. This may need a full provincial review of how municipalities are financed, because that's where it comes back to. And the gravy train of the development charge is about to end. as the absorption levels and sales volumes reduce. So there's another impact on local municipalities' financing. All of these things, usually in our history anyway, lead to really interesting innovation or more creative environments around zoning and the tax levels and the application of those, because the financing on the municipal side is about to be crunched, and the province too. The land transfer tax. Think of a reduction of 50% in terms of revenue. So these things will all lead to discussions about the reality of how we deliver affordable housing, where so much of it today has been the gravy train of tax. So I think that's an area that, coming all the way back to Norm's comment, are the areas that will be impacted going forward.
Ben, are you okay for, I know you have a hard stop coming up. Are you okay for a couple more?
I'm okay for one more minute.
Okay. Is it unreasonable to call this a buyer's market if interest rates make it unaffordable for most of those buyers?
Wow, that's a good question. We have to come up with something else. Unaffordable buyer's market. We call it unaffordable buyer's market. The way it's defined, it is a buyer's market, no question about it. But there are not too many buyers that can buy. I think that's the way I put it. I really apologize. I really have to run.
Ben, you're a gentleman. Thank you for your time. The industry thanks you, and we'll see you on the next one next year.
Thanks, Ben.
Great
being with you.
Same here.
I'd like to thank everyone on our panel, and obviously with Ben here today, for these amazing insights. Just to hear and actually to see, and we monitor all of the questions coming in from you guys in the audience, and it was very robust today. So we appreciate that. That's what really makes these conversations dynamic and impactful for us. I'd like to, we have our famous draw, courtesy of CIBC, as always, for our lunch. And our first winner today, Scott McClellan. Scott McClellan from Plazacor.
Who says there's no free lunch? Way to go, Scott.
I wonder, Scott, if you'd like us to put your name back in for someone. And then our second winner today is Renee Browery from Heathwood. So Renee and Scott, will reach out to you directly with those gift cards for your lunch.
Those are both great friends of PMA, and we didn't rig that. That was all random selection.
My house box is full of names. I'd like to thank CIBC, our title sponsor and our partner in so many ways, to not just to PMA-Brethour, but to every one of you out there. I'd like to thank our event producer, Heathwood Partnership. We're working on season 5 that's starting in January. Stay tuned for that. In the meantime, if you have ideas for topics, if you would like to participate on a panel, if you would like to sponsor, please get in touch with us. My name is Chris Markovic. I can be reached at chrism@pma-brethour.com. We'll see you around on the next one. Enjoy the rest of your day. Thanks a lot, ladies and gentlemen.